There we go. All right. Thank you for joining us for the final session of the second annual Connecticut Affordable Housing Conference. My name is Chelsea Ross. I'm the Deputy Director for the Partnership for Strong Communities. And you all have just participated in 3 days of sessions featuring local, state, and national experts who've been leading conversations to explore challenges, share best practices, and coalesce us around the critical next steps to address the key affordable housing issues in our state. You can still join in on the conversation at hashtag CAHC 2021 on Twitter. Follow us at PSC Housing if you aren't already. And this session is titled Addressing the Racial Wealth Gap Through a More Equitable Home Buying System. And before I turn it over to our amazing presenters for today, we'd like to quickly thank our sponsors, our leading sponsors, the Connecticut Housing Finance Authority, who you'll hear from today, and the Melville Charitable Trust. Their support allowed this conference to happen again this year. And thank you also to our collaborating sponsors, the Connecticut Department of Housing, Webster Bank, and Rockport Mortgage. We also have a set of supporting sponsors that helped make this conference happen, including Beacon Communities, Capital for Change, Corporation for Supportive Housing, Elm City Communities, Fairfield County's Community Foundation, Federal Home Loan Bank of Boston, JHM Group, LISC, National Equity Fund, and Trinity Financial. And then there's a host of session sponsors and conference supporters and advertisers. And we just really thank all of our sponsors for making this conference happen and for keeping it free for all attendees. It's really important and part of the partnership's mission to provide ongoing learning and discussion around affordable housing issues. Last but not least, a big thank you to the sponsors for this particular session. So CHFA, Federal Home Loan Bank of Boston, Citi, Southside Institutions Neighborhood Alliance, Leviticus Fund, and the Department of Housing. A few housekeeping items before I turn it over to our presenters. This session is being recorded. We'll make the recordings available to you as soon as possible. All participants have entered muted. Please stay on mute unless the speaker has asked you to unmute. If you have a tech issue, please select the chat icon in the Zoom control panel and send it in the chat to Chelsea Ross, PSC Zoom meetings, and I will do my best to assist you. And I think you have the chat function to submit content questions as folks go, and then your presenters will address them when they can. With that, I will now turn it over to David Lavery to get started. David?
Hi, how are you all doing? It seems in the screen sharing I may have lost my controls for a minute. There we go. I am Dave Lavery. I'm a staff attorney at the Connecticut Fair Housing Center. I focus on fair lending. The Connecticut Fair Housing Center is a statewide organization. We focus on fighting housing discrimination in Connecticut. Today, I have with me Jon Cabral from the Connecticut Housing Finance Authority and Rashida Rattray from my organization. Jon is a manager at CHFA in the Research, Marketing, and Outreach Department, and he investigates the intersection of housing policy, planning, and economics. Rashida at our organization focuses on direct outreach and education around the many diverse issues in housing and civil rights. We share very similar acronyms with Jon's organization, so I just would like to issue a brief disclaimer that the things that Rashida and I say are not necessarily adopted by the Connecticut Housing Finance Authority. So today we're going to talk about special purpose credit programs, kind of what they are, a history of why we need them, and their legal background and some examples of what folks are doing in this field. I hope you all were able to see Richard Rothstein's presentation. It addresses a lot of the history behind what we're talking about today. We're hoping to give more of a current state of affairs and really leave people with some action ideas that they can take back with them. It's helpful to us if you can put any questions you have in the chat as we go, so we can either answer them in real time or take them up at the end. And just like a brief caveat, the notion of addressing the racial wealth gap is a broad goal, and what we're talking about today is not the solution by any stretch of the imagination. And we're not trying to say that, But I think improving homeownership rates is one of many things that we need to do as a community. And so I'm looking forward to talking with you about that. Since the Great Recession, the 30 percentage point homeownership gap between Black and white people has reached a 50-year high. And it's actually larger than it was before the Fair Housing Act was passed. A goal of special purpose credit programs is to design credit programs, and we're talking about single family homes today, but it can be broader than that, to make credit available to people who would not normally receive it or would receive it on less favorable terms than other folks. So with that background, just a brief agenda. Jon is going to now talk about an analysis of the typical CHFA borrower. And then Rashida and Jon are going to talk about some of the impediments and barriers to homeownership. I am going to give a brief legal background on special purpose credit programs, and then we're going to talk about some concrete suggestions from us and from what other organizations are doing in the US. And with that, I'm going to turn it over to Jon.
Good afternoon, everyone. Just wanted to take a second opportunity to thank the partnership. I've really enjoyed the conference. It's wonderful to have an organization organize an event like this and bring really experts, not only in Connecticut, but nationally to come and talk about housing and affordable housing. And listening to Richard this morning was an amazing highlight. And so I'm honored to not only be a participant, but also be a panelist here with my fellow colleagues such as David and Rashida. So I'm truly honored. Thank you. So I want to take this moment to really talk about CHFA and our homeownership program. I think around conversations regarding race and equity, we oftentimes think about the low-income housing tax credit program, which CHFA is the state's administrator of. But it's really important to also understand that CHFA does provide first-time homebuyer mortgages to low and moderate and middle-income families as well, and that also is an extremely important program in helping build equity, especially for Black and Hispanic households. So CHFA does provide, again, these first-time home buyer programs or loans to mostly low and moderate income households. And it's really a wealth building tool. It helps families grow and increase, purchase an asset that can appreciate over time and help that family. It helps also increase the homeownership rate across the state. And our programs also provide counseling to those who are first generation home buyers who may not understand all the aspects of homeownership. And CHFA is looking to explore expanding that and explore expanding the opportunity for homeownership. But to better understand who our first-time home buyers are, let's just sort of summarize who they are and have been over time. Next slide, please. So we conducted an analysis of who the typical CHFA borrower is. And we did an analysis looking at over the last 5 years and how it's changed over time. In that 5-year period, CHFA has purchased about 11,000 or over 11,000 loans, where over the lifetime of our program, we've actually purchased over, I think, or near 150,000 loans since we started providing first-time home buyer lending. Our median household income over the last 5 years has been just shy of 70,000. So again, these are mostly more like moderate income, even some middle-income households, and they're generally purchasing homes in the $190,000 to $200,000 range. So the first mortgage tends to be about $180,000. Roughly 40% of our borrowers utilize our down payment assistance program, and the median DAP loan is about $9,700. Our median age borrowers in their mid-30s, and that's increased over time. I was looking at some old annual reports that CHFA had published in the 80s, and at one point our median borrower age was in the 20s, in the mid to late 20s. So over the number of decades, we've seen folks delay homeownership, probably for many reasons, but we have seen this slow but steady increase in our median borrower being older. About 12% of our loans go to Black borrowers, whereas about 18% of our loans go to Hispanic borrowers. This is well above and beyond the typical home purchase mortgage percentage in the market. When you look at HMDA data, I think for Black borrowers, it's somewhere around 7 to 8%, whereas with Hispanic borrowers, I think it's about 12 to 13%. So CHFA definitely is an amazing program for families who are looking to purchase their first home, and particularly those who may be first-generation home buyers or Black or Hispanic borrowers. But we do need to understand who our borrowers are besides just these simple numbers, really to delve deeper in how our programs may impact Black and Hispanic families and households, and what we can improve on. Next slide. So we looked more specifically at the demographics of our borrowers, and there were some interesting conclusions or interesting findings in them. And actually, they're probably not necessarily surprising, given if you compare some of these findings with some of the literature that's been published as of recently. I know the partnership had published a report about a year ago looking at borrowers, particularly Black borrowers, and home ownership programs. But one of the things I thought was most interesting was that our Black borrowers tend to be older than their white counterparts. In fact, they're about, on average 6 years older. So they're delaying home ownership longer than white borrowers. And there may be many reasons for this. One of them, I think, Richard Rothstein spoke about today, which is the fact that if you look at sort of the historical context and families building wealth over time, many Black borrowers may not have the assets or the down payment available to purchase the first home. Even though we have a DAP program, it may take longer to accumulate additional wealth to purchase a home. They may be also delaying home purchases due to debt to income, which I will speak on in a couple slides, but these are just sort of interesting findings. In addition, because of the delay in home ownership, our Black and Hispanic borrowers tend to have larger households, tend to have more children in the household. And I think, again, that has mostly to do with the fact that they're waiting to almost 40 years to purchase their first home, which, again, I think is interesting and is something that we don't often talk about when we talk about homeownership and equity. Next slide. So one of the things that the partnership paper that was published last year talked about was the use of different programs for borrowers. And lots of those programs are based on assets and credit scores. So we looked at we look at assets, both liquid assets and total assets of our borrowers, and found that Black and Hispanic borrowers tend to come to purchase a home with less assets, with less that they're able to draw on to, let's say, make a down payment. And I think this has a significant impact to when someone purchases their home, or if someone has a confidence of purchasing a home with the fear of not being able to cover costs or down payment. So that's definitely the case even within the CHFA portfolio. Even within the CHFA portfolio that which allows for programs like DAP, we're seeing that many of our Black and Hispanic borrowers are coming in with less assets, and particularly liquid assets. Next slide. So when we look specifically at the down payment assistance program, I think it's hard to not understand the importance of the down payment assistance program, but there is some unintended consequences or just some realities when you utilize DAP to purchase your first home. So roughly 39% of white borrowers and 17% of Asian borrowers utilize DAP. It's closer to nearly 50%, or just over 49% of Black borrowers who use down payment assistance, and roughly 56% of Hispanic borrowers. While DAP is a wonderful program, I can't stress that enough. When you have a household or a borrower who may use more DAP because they don't have the assets or the cash to put down, they're essentially takes them longer to pay down the debt and see appreciation in their home. So again, the unintended consequence is that you may have borrowers who are a bit more leveraged than, let's say, their white counterparts. Again, not criticizing the DAP program, but that's just the reality. We also looked at gifts. These are a cash that oftentimes family give, usually parents give to children, or grandparents give to children to help purchase their first home. And while the rates of gift giving was about the same across different races and ethnicities, what was interesting is the amount was different. So again, white borrowers tended to have about a $3,500 gift versus Hispanic borrowers who the median gift was around $2,500. Again, resulting in borrowers having to probably either utilize more of their liquid assets or more than likely take out a larger down payment assistance loan. Next slide. So then we looked at what type of program within the CHFA portfolio borrowers tend to fall into. And what was interesting, and again, I don't think surprising for those who again read the report that Partnership published last year or have seen other reports, Black and Hispanic borrowers tend to utilize more of the HFA mortgage programs than white borrowers. A larger majority of Black and Hispanic borrowers utilize the CHFA HFA program. And while it's a wonderful program, it does come with additional costs. Mortgage insurance that may not be as expensive or may not last as long as a conventional CHFA mortgage. And there may be reasons for this. Again, this analysis was only really looking at the portfolio, not looking at our participating lenders' practices. But I think when you look at the level of assets, but really credit scores in particular, you're seeing that borrowers, Black and Hispanic borrowers tend to utilize the HFA program more than others. Again, extra costs to having to purchase a mortgage when using an FHA program versus something that's conventional. Next slide. I think this was actually the most interesting thing. We looked at where borrowers purchased and associated and looked at sort of their race and ethnicity. And I thought it was fascinating to see that, and again, maybe not surprising, but many of our Black borrowers in particular tend to purchase in urban centers. I live in an urban center. I love living in the city, but these are cities that tend to have higher rates of poverty than the first ring, second ring suburbs. So the question is this, while folks have choice to purchase a home, is there more to the story? Are folks not comfortable leaving maybe where they grew up, or are folks being steered? I'm not completely certain. Again, the analysis doesn't go into that level of depth, but it was interesting to see where borrowers are purchasing. And just a note that the average loan size for Black and Hispanic borrowers is about the same as for white borrowers. So it's not a matter of, well, the housing in Bristol, it might be more expensive than the housing in Hartford. That's why folks with higher incomes or with more assets are purchasing in those communities. That doesn't seem to be the case. But there does seem to be a difference in where people are purchasing. Again, something that probably should be further explored. But I thought that was interesting, even within the CHFA lending portfolio. Next slide. So barriers to homeownership. Again, these are just broad observations based on the literature and the research that we've done within our own portfolio. But some of the barriers to homeownership, I think one's clear, is FICO scores, or the traditional method of rating risk. And this can influence the type of product a borrower might be eligible for, or might be given, and add additional cost to purchasing a home. The limited cash on hand. While CHFA does have a DAP program, and CHFA's tweaked the DAP program to be a 1% loan, and which is fantastic and wonderful. But at the same time, it does require a borrower to have additional debt to purchase their home, and may result in a borrower not necessarily building wealth as quickly as someone who doesn't utilize a DAP program. Debt to income. I think this is the primary reason why mortgages are denied across all races, really. If you look at the Home Mortgage Disclosure Act data, the HMDA data, debt to income is by far the largest, the most significant reason for denial of loans. And when you look at the type of debt folks have, I think particularly nowadays, there are many folks with student loan debt. And student loan debt tends to be higher amongst Black and Hispanic individuals because, again, they haven't been able historically to build the wealth that they could draw on to pay for school. So needing to take out more debt. And this has an impact on the housing market and has an impact on who's, at what point and if someone purchases a home, and something that I think needs to be explored. And the other thing, which I think has been exacerbated by the pandemic, is the lack of affordable home ownership inventory in the state. This has been an issue for a number of years, but with the pandemic, it's just been exacerbated by the increased demand on this particular housing stock, and the fact that home prices are increasing significantly, especially over the last 2 years. I know, Rashida, I think you wanted to speak on some of these barriers. Dave?
I think maybe we lost Rashida for a minute. One thing to echo some of what Jon has said, though, is, we're talking to a certain extent about what we think of as traditionally objective criteria set forth here, and without getting into how sometimes objective criteria may have originated from a place that makes it discriminatory. One thing that the center has found over the last 10 or so years of investigating what's going on in the lending market is that borrowers or applicants of color are much more likely to be told that a credit score is too low, or that a debt, even a debt that we know to be reasonable, is problematic. And so some of these issues that morph into objective reasons for denying someone a loan start off as, an opportunity for a coaching of a potential borrower that goes sideways much earlier in the process. And then, the other thing I'd like to mention is lenders make active choices about where they're going to compete for business and in how they're going to structure their business. So, we've seen recently more and more of the home purchase market being taken over by non-bank lenders who maybe don't have the same community reinvestment act obligations as banks do. We're hopeful that CRA coverage, Community Reinvestment Act coverage, is coming to non-banks who are in the mortgage market. The other thing that I came across recently, just looking at two lenders, one in the Philadelphia market and one in the Hartford MSA, is that the banks have a number of branches in the community, but they've placed no loan officers in the cities. They've only placed their loan officers in the ring suburbs. And so part of it is from the objective criteria, but certainly part of it is also from active conduct on the part of lenders. Rashida, do we have you back to jump in here?
I'm here. Please forgive the technical difficulty that I just experienced. My computer just completely blanked out right before I was supposed to speak. So here I am. Grateful for the opportunity to be a part of this panel. And one of the things that I did want to highlight, as working for the Connecticut Fair Housing Center, I've learned a lot about, racial disparities and the reason why, there is a racial gap between homeownership, between Black and Hispanic families, and that was not accidental, that it was something that was a byproduct of systemic racism, which includes segregation, it includes redlining and other anti-Black policies that targeted Black and Hispanic people that lived in predominantly Black and Hispanic neighborhoods. The experience that I gathered from, some of the previous hats that I wore kind of gave life to this learning that I've received at the center and linked my lived experience with historical context. So in my previous life as a housing counselor, I was able to actually get in touch with individuals that were going through the home buying process, that were going through the 8-hour home buyer education classes that are offered through CHFA. And one of the barriers that I did find, which echoes the sentiments that Jonathan explained earlier, is the lack of capital in, Black and Brown communities. And that is one of the main reasons that I saw firsthand is that our communities are severely underbanked, right? Individuals don't trust the bank. They don't trust the bank enough to put their money in it. There are individuals and clients that I've met with that have flat refused, right, to put their money in the bank. So they may have the capital, but it's not in the bank, right? I personally was raised by the mattress mantra. I don't know if anyone else has experienced that, where, all of our important documents, all of the money that my family would have saved would be under the mattress as opposed to being, in the bank, and not understanding what that was until I really started digging into why and learning more about the context behind that. I just recognized, that our communities are underbanked. Another barrier that I saw was the lack of access to credit, and then just poor credit history, right? Again, just crediting CHFA for, the comprehensive 8-hour homebuyer education class and how it goes through credit and it goes through budgeting. A lot of the clients that we met with after the class would express that they had no idea of, what composed a credit score. They had no idea that, if they had a credit limit of $1,000, for example, they probably shouldn't go over the 50% line, or that's going to negatively affect their credit. So it's just, the feedback that I've gotten from clients as well in the past is, I wish I would have known this sooner. I wish I would have had this information years ago so I could have started, preparing, because they weren't aware that credit would play such a huge part in home buying. Because as I stated earlier, there are some people that have the cash, that may have the reserves. Not everyone, but some people may have the reserves, but they don't have that somewhere that it's in a bank where it can be accounted for. And this is what ties in again to the traditional methods of looking at DTI and assessing risk and credit. These traditional methods are ineffective when you're working with this community of people. DTI, I don't know what parameters they're using to assess DTI, but I'm pretty sure they should be examined and maybe changed. But people of color often have higher DTI ratios than other races that are applying for mortgages. Then I had a conversation with a loan officer while I was working at a housing counseling agency, and this was a candid conversation. And when I spoke to him, he explicitly said, I don't like doing CHFA loans because it's a lot of extra paperwork that I have to do, right? So there is some pushback from some loan officers or some borrowers with regards to doing CHFA loans, right? I did have a client. She came to the first time home buyer education class. She recognized what she needed to work on as far as her credit was concerned. We had 3 one-on-one sessions where we sat, we talked about her debt to income ratios. We talked about her credit score. We got her on the right track to what she needed to do to be able to buy a home. And now she got to the point where she had the reserves, she had the credit score, she was ready, she had the information that she needed, and she went into the bank. And the lender that she went to was pushing her towards an FHA loan. And she didn't mention that she wanted a CHFA loan. She didn't mention anything about CHFA when she went in, but she noticed that this individual was pushing her towards an FHA loan when she easily could have qualified for a conventional loan. So people are not mentioning that CHFA loans are an option. And my last point with regards to affordable housing, which will lead into the next slide that Jonathan will cover, is that there's just a lack of affordable housing or homes in the price range of clients who are finally ready to buy a home. Or when they do find a house, there's an inordinate amount of rehabilitation or construction that needs to be done on that house, in which these families may not have the reserves to cover that. So I've noticed that, it's counterproductive to put a new homeowner in an old home. But a lot of the times when people pre-qualify and they get their pre-qualification amount, they can't necessarily find a home that is newer or brand new in that price range. Unfortunately, they are stuck sometimes with going into these homes that do need a substantial amount of rehabilitation, and they may not have the reserves to cover that. So that would lead me to throw it back to Jonathan and getting into the next slide about affordable homes.
Yeah, great. Exactly. I think there's so many different interesting points there. And in the fact that our housing stock in Connecticut also contributes to the barriers of homeownership, particularly first generation home buyers and Black and Hispanic borrowers in particular. So if you look at even just since the pandemic, I think some of the things that we've seen is that pre-pandemic, really 2017, the median home sales price was about 188,000, which was in line with sort of the typical CHFA first-time home buyer mortgage or home price. But with the pandemic, we've seen home prices just increase dramatically, and it's last I checked, it was just around $215,000. In 2021 alone. So a pretty significant increase in home prices. And while this is still within CHFA's home sales price limits, it does add additional costs to many families who just can't afford to purchase a home at this level, and especially if they don't have additional resources. So the demand for homes within sort of the typical CHFA borrower price range is up, and it has been going up for a few years now, but with the pandemic, it's increased significantly. And part of that is investors. Investors are in the market purchasing homes and renting them out. So investors who come in with cash oftentimes will purchase homes. We're seeing borrowers actually come in and for the first time since in the data that we collected CHFA back in 2020, between April and May, or April and June, we saw for the first time more cash buyers than we saw folks purchasing homes using a mortgage, and so that's pretty significant. We've heard and seen plenty of stories of folks from New York purchasing homes, particularly down in the Fairfield County area. And while that's not as widespread as I think some folks have written about, with the lack of construction, with the lack of new homes in the market, you don't need many folks from another state like New York to come up and have significant impacts on home sales prices. One building empties in Manhattan and comes to Connecticut and throws a whole entire housing market out of whack. So we're seeing that, and this again contributes to additional barriers to home ownership. And interestingly enough, while the state's population isn't growing, and I've heard this over and over again, why would we want to build more homes if we have a stagnant or even shrinking population? The number of households has increased. We're seeing a lot more one-person households, and we're seeing a lot more just folks who are moving out of maybe, let's say, their parents' homes and purchasing their own homes. So we're seeing an increase in households needing units. And this is again impacting, adding additional demand and pressures into the market. Next slide. So here I've sort of outlined sort of new construction over time, and you can see really since 1990, home construction, home ownership production has dropped. It's dropped significantly. And while there are things written about this, I say one of the things that I have not seen oftentimes cited is that here in Connecticut in the late 80s, early 90s, some folks may remember, I do remember this because my father worked construction at the time and was laid off in the late 80s, early 90s, was the fact that the savings and loan, many savings and loans had collapsed. A lot of local banks went out of business, and those were the organizations, those were the lenders that were primarily driving construction of home ownership units, especially condos. And so they left the market or just disappeared altogether. And there really hasn't been anyone who has come into the market to finance or fund new homeownership units since that aren't larger McMansion type homes. So interesting. Next slide. When we look at the types, when we look at churn of housing stock, CHFA, we get a monthly, we get data from the Warren Group monthly that looks at home sales throughout the state. And when you look at the churn of homes that are affordable to or within sort of the typical CHFA borrower would purchase, we notice that many of the homes that tend to churn are those built in let's say the 80s. And again, I think that's primarily because during the 80s, late 70s and early 80s, mid to late 80s rather, there was a condo boom, and these condos tend to be the most affordable units in many of the markets. So they churn, they tend to be decent first-time homes for folks who are purchasing their first home, and then folks generally will sell them and upgrade, but or get larger homes, but that seems to be where the churn is. And really, when you look at housing that was built after, let's say, 1990, you don't see much churn. It could be because they're newer homes, but they're were primarily homes not built for the typical first generation buyer, the typical borrower who'd come to CHFA, which means that most of the housing that's being bought by CHFA borrowers or by first generation borrowers or by by moderate income borrowers tends to be older. Rashida pointed that out. They tend to be almost homes that are up 70 years old. They tend to be in urban areas and oftentimes require additional upgrades, right? So our folks are purchasing older homes. While they may be more affordable, they do require some investment. Next slide.
So we're going to talk now just about the framework for special purpose credit programs and some thoughts about how to implement them. Craig had asked a question in the chat. Scroll up to it. He indicated that his nonprofit builds homes for first-time low, moderate income buyers, and they get more applicants than they have houses for, and they wish they could give preference to Black families, but they can't due to fair housing laws. I'm hopeful that this next section will answer that question for Craig and anybody else interested in this particular issue. A special purpose credit program is a program that's permitted under the Equal Credit Opportunity Act, or ECOA, and it's implementing Regulation B. The goal of a special purpose credit program is to benefit a class of people who would not receive credit from the lender or would receive it on less favorable terms, meaning a higher closing cost or interest rate. It's available to for-profit and nonprofit lenders. The lenders need to put together a written plan for how they're going to administer the program, and it needs to be quite clear that it's going to be for people who wouldn't normally qualify for existing programs. On the next slide, I have some examples of things where I think some lenders are doing special purpose credit type programs. I also think that they're primarily for white folks, and I'm going to discourage people from trying to do these programs. But you can see that there are programs that exist. You see SunTrust talking about up to 100% financing and no mortgage insurance. The Laurel Road, these loans have fewer restrictions and recognize the lender's trust. Bank of America, we're going to relax on your student debt. Maybe we'll even exclude it if you can show us that it's deferred in some way. And that's a major benefit that would be good if it was available to folks who wouldn't normally qualify. I mean, I don't think any of us think that a doctor is not ultimately going to qualify for a mortgage. So
down payment being paid by, what about the closing?
Sorry. So some thoughts about how to develop special purpose credit programs is think about maybe getting away from credit scores and traditional notions of debt to income. If folks have high student loan burdens, but they're on income-based or deferred payment plans with those, then account for that in the underwriting process. one of the issues with our housing finance system and how it assesses risk is it tends to reinforce the historical effects of redlining and the disadvantage that applicants of color already face in the mortgage market. As John had said, down payment is important, and there are great programs out there. It's also a little fractured in that there's a lot of different people who have their own down payment assistance program. And another issue that we see from a fair housing organization point of view is that the interface for people to get to down payment assistance typically runs first through the lender. And as Rashida mentioned, lenders may not want to do it. You may see someone who really should get down payment assistance get pushed away at an early stage, and so they never receive it, or they get into a product that's more expensive to them. I have some other suggestions for folks who are interested in this. Just looking at how the VA has done their lending over time, it's a little bit different, and it makes it a little bit more affordable. A group in Massachusetts has coupled MAHA, and I forget what that stands for, but it's MAHA. They couple their down payment assistance and their special purpose program with a savings match credit checking account. And realistically, some of these programs may need higher income limits than we've traditionally thought about having. So with that, I'm going to give you a couple of examples. I'm sorry, I have one more slide here. I think one important thing to emphasize about down payment assistance is John also mentioned, it adds an expense for folks, and it reduces the available equity. So transparency is very important, and quality housing counseling much earlier in the process, perhaps even prior to someone interfacing with a lender, is very important. So I'm going to try to address most of the questions at the end, but Craig's question, I think, is going to be answered, hopefully, at least in part, by our first example of what a special purpose credit program could look like, and that is what some groups are rolling out and calling first generation home buyer programs. And what these are is a home buyer program that's designed for, and a criteria of the program is that the applicant is someone whose parent or legal guardian did not own the home of that person during that applicant's lifetime. So when you think about who has typically been left out of the home ownership market, it's typically people of color. And so a program that is focused on first generation home buyers is probably more likely to pick up people of color as qualified applicants. And it is a way to target these programs to serve our stated goal of addressing the racial wealth gap. And a note about median income before I turn it over to John to talk about other ways of using special purpose credit. We design a lot of our programs about median income, or around someone's median income. But an issue with median income is it's exactly half of the people in an area fall under median, and exactly half the people in an area fall above median income. So if you put a program that's designed to address racial equity issues, but is targeted solely based on median incomes, then it's likely that you're going to mostly pick up white people as people who qualify for that program, just as a numbers game. So I encourage people to think about other programs, and I will emphasize that again at the conclusion, but I will let John now talk about some other ways to use credit. So
yeah, some great points there, and actually there's some great conversations, weird questions coming from the chat, and I just wanted to address a couple of them. So CHFA, so the CHFA DAP does contribute to the debt to income ratio. It does have an impact on debt to income. So just wanted to answer Sean's point. There's also been a number of questions regarding repair, purchase repair program. So yes, that's something that CHFA does offer a 203K program. However, quite frankly, it's only offered by, I think, one of our participating lenders. It's a difficult program to monitor. It's a difficult program to administer. I think personally, we do have an older housing stock here that, especially in our cities, that have significant needs, and there needs to be an evaluation of the purchase rehab and how we can do that. Unfortunately, the cost of rehabbing some of these homes is just so significant, it may put someone underwater. So I think folks need to really think about the housing stock and what we can do better around it. But really, it's the adding of units, the adding of supply into the market. While the population of the state hasn't grown significantly in a number of decades, but the number of households has. And we do have first generation, mostly Black and Hispanic borrowers who are looking to purchase. And so I think there's a value into building a first-time home buyer type house. And traditionally, that's been done through developers who work in that market. And the reality is, from what I understand, we don't have many developers in that market here in Connecticut. And that's probably as a result of the fact that we just haven't had much funding or lending to help build homes. So, a revolving loan fund that would help developers, build and sell homes, I think would be something that would add value. For a number of years, CHFA has worked with CDFIs, such as Capital for Change, and to finance the building of single-family homes. But I think we need to bring some of our private lenders back into that market. And I think the CRA is wonderful. I worked in CRA for years. But when you look at how banks do community development lending, they tend to look at rental. And they look at the LIHTC program, and they look at programs like that to reach their objectives. And there isn't that much when it comes to at least the single family production side, maybe lending side, but not the production side. So I know that other HFAs throughout the country have started looking at revolving loan funds and lines of credit for developers, Florida being one that recently has launched an RFP. But I think other organizations need to think more holistically about how do you encourage homeownership development.
And jumping in to talk a little bit more about the affirmative marketing, the education and outreach coordinator in me is going to say that there needs to be more education and outreach to these communities and to these people that have been, disenfranchised with regards to not being able to gain home ownership. With regards to affirmative marketing, maybe even creating a solid plan to identify these people, to identify these neighborhoods, and develop a comprehensive outreach plan around making sure that there are clear indicators to measure the success of the program and around these individuals so that they are aware of credit, they are aware of the things that they need, and aware of these barriers that may come when they're trying to buy a home, and making sure that when we're advertising this initiative, when we're marketing, that we are making sure that it spans a multitude of different channels, whether it be virtually or physically, but more importantly, getting in contact with community organizations. I think I saw in the chat box a question with regards to municipalities and how municipalities would be able to help. If we can come up with a affirmative marketing plan, loop in municipalities, loop in these community organizations that deal with people, that are on a one-to-one basis with people, and know the needs of their community, I feel like it will be even more better for them, so they can understand that there are people out here that are trying to help you to attain that goal of homeownership.
Excellent points. The idea is all of these things are possible under a special purpose credit type program if you put together the plan. The leading one at the moment seems to be the idea of first generation homebuyer programs, but that is certainly not the only way to structure a targeted program. You have to do the work to do it. You have to identify the people. It doesn't have to come from your own data about who your applicants are. It can come from something like the Home Mortgage Disclosure Act data or from the census data. But you have to put in the work to do it. And one of the things I wanted to say today is that this is an area that the Connecticut Fair Housing Center is hoping to be able to partner with people on and start to help groups who are interested in doing this figure out how to do it. You know, a longstanding concern from lenders in particular has been, how do we implement these programs and also comply with the Fair Housing Act? And it just comes back again to doing the work. You know, for a while there wasn't any clear guidance, but it seems that December of last year, December 2020, the CFPB put out an advisory opinion on how to comply with the ECO without violating the Fair Housing Act. So, you know, that's kind of, you know, our suggestion is we're here to be a partner with groups who are looking to do that work. And obviously, if you're a nonprofit, it's probably a little easier. The standards are a little more relaxed. If you're a for-profit lender, you can do it, but you probably need to engage a little bit with your regulators in addition to community groups. With that, I'm going to let Jon talk about CHFA's 3-year strategic plan, and then we'll go through any leftover Q&A that we didn't get to yet.
Yeah, I'll sort of go quickly through this. So, you know, this is one of the things when we look at equity, this has been something fundamental in CHFA's 3-year strategic planning initiative. And CHFA has worked with staff, has reached out to folks in the community to get a better sense of what's missing in the market, where CHFA can help. One of the things we heard, and I think is really important, is this idea of providing, so Rashida, to your point, more education, more outreach, more marketing, just so folks understand what's out there, and for folks to understand you can be a homeowner and it can work. While there are costs to it, and while there might be surprises, there's support out there that may help you. And CHFA is looking to expand, maybe providing those supports, more wraparound services, not so much at the point before purchase or the point at purchase, but what happens when after someone purchases. If someone needs to do some stuff to their home, or they need a new furnace or boiler, to act as a resource to provide courses or education on where you go, how best to find a contractor, stuff like that, which I think there are organizations that do it, but to try to expand that. Because I think that's vitally important, particularly for first-generation home buyers who may not necessarily be able to call a mother or grandfather and say, "Hey, what would I do in this case?" And Richard Rothstein's book touches a lot on this. But while the income gap has shrunk over the last few decades, the homeownership gap hasn't. It's increased. So it's being able to go into those communities to better understand what are these barriers. And again, I think it's education. I think it's providing services, is also having a better understanding of unintended consequences of programs that we do have. And CHFA's 3-year strategic plan really is geared towards better understanding the market and providing, again, a support structure around those who look to purchase their first home.
Just going to do a couple questions. Aaron Kemple, my boss, asked, how do we stop investors from taking over the market? I think that may be slightly beyond the scope of what we can manage today, but I would just say that, robust fair housing enforcement and, what you see when you have big investors jumping into the single family housing market is that housing stock stops getting repaired. And so, another way to combat that is code enforcement and to make it unpalatable for the investors to jump into the market. Rashida, if I can direct this question to you, Melissa asked, a lot of the time the communities are not aware of the classes and how to access them. And I just interested in your thoughts on that one.
That is absolutely true. That is something that I've experienced as a housing counselor, that people didn't even know that we existed. So a lot of it is just making sure that when we're touching bases with these housing counseling agencies, that we're making sure that they do have a solid outreach plan with regards to, making sure that they are touching the people in their community and kind of holding them accountable for that. right? Making sure that they are putting their name out there. The housing counseling agency that I was working for, thankfully, you know, they had a lot of different ways to do outreach, right? Where, you know, scheduling a day of a community event, going out to local schools, making sure that local restaurants knew who we were and knew the services that we asked or that we offered. So it's really on the agencies themselves to do that outreach, because it's not as if we don't know that that service is necessary, right? We know that that service, the services that they provide, the credit counseling, the pre-home ownership counseling, all of that is completely and totally necessary. So I think it's one, you know, holding the housing counseling agencies more accountable to do outreach and make sure that people know about their services. And also, again, going back to, I think, Melissa, you were the one that raised the point about municipalities, maybe linking in municipalities so that they're aware that these programs and services exist, so that people in the community are able to access them.
And just one other note, because there's been a couple other questions, I think, about investors crowd jumping in. You know, another kind of an area that folks could explore things is at least in areas where larger bodies are taking title to foreclosed properties, for example. Maybe it's possible to have a system where foreclosed properties are offered to community groups who are going to then market those to first generation home buyers first before they're opened up to the investor market, and make it a little bit of a competitive advantage for the folks who are trying to do the good work. I think we've got all the questions covered. I know not necessarily directly. If anybody else has any last minute questions, please pop them in the chat or remind us about your question now. Otherwise, I think we'll let everybody out a couple minutes early.
Well, maybe some last questions are popping in the chat. I just want to thank you all, because this is our last conference, or our last session of the conference. And thank you to Rashida and John and David for putting together a really informative and important presentation on the home buying system. And remind folks that this recording and all the recordings from the last 3 days will be processed over the next couple of days, and we'll send out an email when they're available on YouTube, so that you can watch sessions you weren't able to attend and share ones that you were with other folks in your network.
I just want to just say something really quick. The analysis that we had done CHFA in our own portfolio will be published on our website. And we also have data portals that are public on our own lending and HUMDed lending and just the single family housing market in general. Those are accessible. So folks who want to delve in and see what their towns look like, please do. And give us feedback on those tools, because there's always room for improvement.
Awesome. And that's a good call to just continue the conversation overall, right? You've heard amazing things over the last 3 days. Lots of presenters have offered their contact information. You'll get slides. Let's keep the conversation going. We expect to be back here again next year, which will sneak up on us, and inviting you all to the 3rd annual Connecticut Affordable Housing Conference. So start thinking about ideas of sessions that you'd like to see. Shoot them my way. Sessions you'd like to put together. I'm happy to commit people a year in advance. And we'll look forward to seeing everybody hopefully safely in person again soon. But thank you all for joining us virtually, and have a great rest of your Wednesday.
Thank you.
Bye all.
Thank you.
Take care.
Everyone. Thanks, Chelsea.